There's a group of people in Washington you never voted for. They don't run a company. They don't command an army. And yet, with a single decision made in a single afternoon, they can raise the cost of your mortgage, cool down the job market, move the price of almost everything you buy, and send the stock market soaring or crashing. They are the Federal Reserve, America's central bank, and arguably the most powerful economic institution on the planet. Presidents come and go, but the Fed quietly steers the whole ship. And here's the strange part. Almost nobody can actually tell you what it does. So let's change that. In plain English, what is the Federal Reserve, and why does it hold this much power over your life? Start with what the Fed is not. It is not a regular bank where you keep your checking account, and it is not quite a government department like the post office either. It's something stranger. It's a bank for banks, and the bank for the government. Ordinary banks keep their accounts at the Fed, the same way you keep an account at your bank. It was created back in 1913, after a string of financial panics finally convinced America it needed a referee sitting above the banking system. Congress handed it a job, often called its dual mandate: keep prices stable and keep as many people employed as possible. Two goals, one institution. The other thing that makes the Fed unusual is its independence. The president appoints its leaders and the Senate approves them, but once they're in, they are deliberately shielded from day-to-day politics, so they can make deeply unpopular decisions, like intentionally slowing the economy down without simply being fired for it. In theory, that independence is a feature, not a bug. In practice, as we'll see, it is also exactly what makes people nervous. So how does the Fed actually steer the economy? Its first and most famous tool is the one we met last time: interest rates. A committee inside the Fed meets about 8 times a year and sets a single benchmark rate, the rate banks charge each other to borrow overnight. Remember from the interest rates episode, almost every other rate, your mortgage, your car loan, your credit card, your savings, is built on top of that one number. So when the Fed moves it, the entire economy feels the shift. When things are running too hot and prices are climbing, the Fed raises rates to make borrowing expensive, which cools spending down. When the economy is sluggish and people are losing their jobs, it cuts rates to make borrowing cheap, which heats things back up. Think of it as a thermostat for an entire country, except the temperature takes a year or more to respond, and if they turn the dial too far in either direction, they can tip the country into a recession or let inflation run wild. It is an enormous amount of power resting on a surprisingly imprecise instrument. But interest rates are only the Fed's everyday tool. In a real crisis, it reaches for something far more dramatic. It can create money out of nothing, on a massive scale. You have probably heard the phrase money printer. This is what people actually mean by it. When the financial system was collapsing in 2008, and again when the pandemic hit in 2020, the Fed conjured up trillions of dollars, not physical bills, just numbers typed onto a screen, and used them to buy up government bonds and other assets. This floods the banking system with cash, pushes interest rates down even further, and is meant to stop a crisis from spiraling into a full-blown depression. Economists call it quantitative easing. To give you a sense of the scale, before 2008, the Fed held under $1 trillion in assets. A decade and a half later, after repeated rounds of this, it held close to $9 trillion. That is an almost unimaginable amount of new money, created by an institution most people couldn't even name. And as you might guess, all that money does not land evenly. Which brings us to the uncomfortable part. Here's the part that's worth arguing about in the comments. When the Fed creates trillions of dollars and pushes interest rates to the floor, that money has to go somewhere, and it tends to rush into assets, stocks, real estate, and the like. So the prices of those things shoot up. Now ask yourself a simple question. Who owns most of the stocks in the property? Not the average worker. So the Fed's emergency medicine, however well-intentioned, often makes the people who already own assets richer, while someone living paycheck to paycheck just watches their rent and their grocery bill climb. Critics argue that central banks have quietly become one of the biggest engines of wealth inequality in modern history. And there's a second tension. The markets have learned that whenever things get scary, the Fed will ride in to rescue them. Traders even have a nickname for it: The Fed put the comforting belief that the central bank will always catch a falling market. That belief can encourage exactly the kind of reckless risk-taking that causes crises in the first place. And remember, the people making these world-shaping decisions were never elected by you. They may be brilliant and well-meaning, but that is a staggering amount of unaccountable power, and you are right to find it at least a little unsettling. Consider what happened after 2020. The Fed flooded the system with money, and within about 18 months, the stock market and home prices were hitting record highs, even as millions of people were out of work. Those who owned assets had perhaps their best year in memory. Those who didn't fell further behind and then got hit a second time when all that new money helped push inflation to a 40-year high. The same policy, opposite outcomes, depending entirely on which side of the asset line you happen to stand on. That, more than almost anything, is why the Fed has quietly become one of the most politically explosive institutions in the country. So if the Fed is this problematic, why not just get rid of it? Here is the honest case for the defense. Before central banks like this existed, the economy was brutal and wildly unstable. In the 1800s and early 1900s, America suffered banking panic after banking panic. Banks would collapse, ordinary people would lose their entire life savings overnight, and there was simply no one whose job it was to stop the dominoes from falling. The Fed was created precisely to be the adult in the room. The lender of last resort that steps in when everyone else is panicking, exactly as it did, as we saw last episode, to stop bank runs from spreading. And by most measures, it has worked. The violent boom and bust swings of the old days are gentler now. The trade-off is real. We hand a small group of unelected people enormous power, and in exchange, we get a financial system that, most of the time, simply does not collapse. The Fed is far from perfect. It has been too late. It is overshot. It has arguably helped inflate the very bubbles it later had to clean up. But the world without any referee at all was demonstrably worse. Let's land the plane. 3 things to take with you. 1. The Federal Reserve is the bank for the banks and for the government, with 2 jobs: keep prices stable and keep people employed. 2. It steers the economy mainly through interest rates, and in a crisis it can create money on a massive scale. 3. That power genuinely saves the system from collapse, but it also quietly picks winners and losers, and it rests in the hands of people you did not elect. So the next time you hear that the Fed raised rates or launched another round of stimulus, you'll know what's really going on beneath the headline: a thermostat being nudged, and trillions of dollars quietly reshaping the economy around you. Next time, we'll head to the place where a lot of that money ends up, and where fortunes are made and lost every single day: the stock market, explained in plain English. Subscribe to Plain Economics. No jargon, just plain.